For years, one idea has shaped the modern investor mind. Just by the index, the S&P 500 always goes up, about 10% a year. It sounds safe and it sounds rational. For many people, this line is the entire investment strategy. But here's the question we rarely ask. Why did it go up so reliable? And what if the word that makes those numbers possible isn't coming back? Meta, Alphabet, Amazon and Microsoft, the most valuable companies in the world right now, are spending like a drunken sailor. They're expanding their capex to a level now make up almost 40% of the S&P 500. The 10% a year story came from that context, not as a rule of Passive investing has become the default strategy for millions. In the United States alone, passively managed mutual funds and ETFs now hold over $16 trillion. The forces that quietly powered a century of growth, demographic, globalization, cheap energy, are changing in fundamental ways. And as passive funds grew larger, they created something unexpected. They shifted real power away from individual investors and into the hands of proxy advisory giants like ISS and Glass Lewis. So in this video, we'll trace how passive investing reshaped the market. If the 10% a year is as safe as it sounds, and we're going to ask whether the AI boom that's driven so much recent growth might be starting to crack. Hi, welcome to another episode of Economic Observer. 7 companies, the so-called Magnificent Seven, now make up almost 40% of the S&P 500. This kind of dominance would have been unimaginable a generation ago. Nvidia alone reached nearly 8% of the index. That is the highest weight a single company had in the S&P 500 history. At one point, it was worth more than the entire US energy sector. And the concentration runs even deeper. If Nvidia, Apple and Microsoft were removed from the S&P 500, the index's return over the past 3 years would have been cut in half. That's not diversification. It's a bet on a handful of companies disguised as a diversified strategy. Meanwhile, passive funds raised over $1.4 trillion in 2024. None of that money evaluated business model, management teams or competitive modes. It simply bought whatever the index dictated. And because index funds allocate by market cap, the biggest companies automatically get the biggest slice. That's why if you invest $1 today, roughly 38 cents end up in just 7 boardrooms. It creates a market structure where the performance of a handful of companies now drives the retirement outcome of hundreds of millions of people. To understand why these few giants could rise so high, we need to zoom out, past Wall Street, past the 1990s tech boom, back to the moment America's economic story began. The consistent returns of the US stock market in the last century came from a unique combination of forces that define the environment in which the S&P 500 have the opportunity to grow. Let's walk through how each piece fell into place, building the greatest wealth engine in history. Between 1900 and 2000, the US population quadrupled, from around 76 million to over 200 million. More people meant more workers producing goods and services, more consumers buying those goods, more entrepreneurs starting companies. Each generation was larger than the last one. That meant steady growth in demand for homes, cars, credit, education, and eventually investments. Together with population growth came industrialization on a huge scale. The US mastered assembly lines, electrified cities, and became a manufacturing powerhouse. Henry Ford's production methods showed how standardization and scale could transform entire industries. Workers were paid enough to buy the products they made. That created a broad middle class and a domestic consumer market that supported large corporations. US markets still benefit from this structure, But now much of the production sits elsewhere, and the social and political side effects look very different.
I directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
In 1944, representatives from 44 nations made a decision at Bretton Woods that would shape the next 80 years of economic history. The US dollar became the world's reserve currency, replacing gold as the anchor of international trade. From that moment forward, global commerce, energy markets, and financial systems revolved around American currency. Countries needed dollars to buy oil, to settle trade, to hold reserves. That meant continuous capital inflows into American assets, especially US stocks and bonds. For 8 decades, this dollar gravity helped fund American prosperity, keeping interest rates lower than they otherwise would have been and ensuring steady demand for US investments. On top of that, perhaps the most powerful tailwind of all, the era of cheap money. From 1981 to 2021, interest rates fell almost continuously. Paul Volcker broke inflation by raising rates to nearly 20%. Then, they descended for 40 years. Each rate cut boosted valuations, made borrowing easier, and pushed asset prices higher. By 2021, rates had hit zero. Central banks were buying bonds by the trillions. Money was effectively free, and investors had nowhere to go but stocks. These forces created an extraordinary century when nearly everything went right for American capital. The 10% a year story came from that context, not as a rule of nature of passive investing. Now, one by one, those tailwinds are weakening. The 2020s mark a new phase. Technology and ideology now define the contest between the world's two largest economies. Export bans on advanced semiconductor, sanctions on Chinese tech firms, and rare earth export restriction introduce volatility that no index model can smooth it out. This represents a fundamental restructuring of the global economic order, one where supply chains become weapons and technology companies become strategic assets. The integrated war that made globalization profitable is fracturing into competing blocks, each building parallel systems that reduce interdependence. In response, factories are moving from China to Mexico, India, and Vietnam, and other nations which are politically safer. Companies are spending billions to duplicate supply chains. The goal is no longer maximum efficiency, it's resilience and political acceptability. Transition cost rises and efficiency falls. Short term, this is a drag on margin. Long term, it may prove necessary, but either way, the free lunch of global optimization is over. Meanwhile, more nations are trading in local currencies, exporting alternatives to dollar-based financial systems. Saudi Arabia is accepting yuan for oil. Brazil and Argentina are settling trade in their own currencies. Russia and India have developed rupee to Russian ruble payment mechanisms. These aren't yet essential threats to dollar dominance, but they represent cracks in a system that seemed unshakable a decade ago. Conflict in Europe and tension in the Middle East have reintroduced risk into energy and food supply chains many assume were stable. For years, government enjoyed peace, which means lower defense spending, more integration, and cheaper trade. Let's not forget about inflation. It's more stubborn than central banks expected. The pandemic supply shocks combined with massive fiscal stimulus, deglobalization, and energy disruption have pushed prices higher. Taken together, these changes create a different world than the one that produces a smooth 10% a year story. Now here's something that shattered assumptions in 2025. The S&P 500, long considered the gold standard of global investing, ranked 41st out of more than 60 stock indexes worldwide. Despite posting a respectable 16% return to November, it trailed the MSCI All Country World excluding US index by more than 10 percentage points. Goldman Sachs strategists project that over the next decade, emerging markets could return nearly 11% annually, compared to just 6.5% for the S&P 500. Each generation believed they found a system that can break. In 1929, prosperity was declared permanent. Stocks had become so reliable that buying on margin seemed like the obvious choice. Then came October, and permanent returns disappeared. In 1999, the internet was rewriting valuation logic. Earnings didn't matter because eyeballs and network effects would eventually generate profits so enormous that current prices would look unusual. Companies with no revenue commanded billion-dollar valuations. Then the bubble popped, and $3 trillion of paper wealth vanished. In the mid-2000s, housing was treated as a risk-free asset that never goes down nationally. Each time, a story about permanence formed. Each time, conditions have changed. Artificial intelligence has become the story that justifies current valuations. Investors believe we're at the beginning of a transformation as significant as the internet itself, perhaps even more so. And they might be right. AI is genuinely revolutionary. It's rewriting software development, transforming drug discovery, and reshaping how companies operate. The technology is real. The applications are proliferating with a vast potential. But the spending required to pursue the opportunity is enormous. Meta, Alphabet, Amazon, and Microsoft, the most valuable companies in the world right now, are spending like a drunken sailor. They're expanding their capex to a level we've never seen before, and that's what's keeping the stock market up. Just in the last quarter, their capex has been over $100 billion. They're draining their cash reserves. They're getting into debt. These companies used to have the cleanest balance sheet that we've ever seen. And while this investment rate accelerates, AI itself might become commoditized. We are already seeing Chinese labs producing competitive models at a fraction of the Western cost, often with similar or near similar capabilities. If this trend accelerates, if training efficiencies improve, if open source models continue closing the gap, or if international players undercut US giants, the companies spending the most today might find their expensive advantages disappearing. The risk isn't that AI will fail. The risk is that the biggest spenders in the Magnificent Seven keep putting billions into GPUs and data centers without ever earning the returns needed to justify the cost. Understanding that conditions are changing doesn't require abandoning sound principles. Diversification still matters, perhaps even more than ever. Low cost still compounds over time. Patience still beats panic. But adaptation means thinking more carefully about what diversification actually means in the current environment. Owning the S&P 500 isn't as diversified as it seems when roughly a third of it's concentrated in 7 companies, all in related industry, all exposed to similar risk. True diversification might mean international exposure. It might mean small cap and value stocks that don't move in tandem with mega cap growth. It might mean commodities that hedge against inflation, real estate that generates income independent of stock prices. Bitcoin increasingly looks like it's not going away. In a world of rising geopolitical tension and persistent inflation pressures, it offers properties that traditional financial assets don't fully match: a fixed supply, global accessibility, and independence from both corporate earnings cycle and central bank policy. For some investors, that makes it worth considering it, not as a lottery ticket, but as one component in a broader hedge. The takeaway here is not to avoid the S&P 500. It can still be a sensible core holding. The real risk is treating it as a guaranteed 10% per year machine, and then building aggressive behavior on top of that assumption. When people start borrowing to buy broad indexes, piling into leverage ETFs, or buying call options on every small dip in Nvidia, Tesla, or Meta because the market always goes up, a long-term tool quietly turns into a short-term gamble.